In this video, guys, we're going to look at ideas for trading a fast market. Stay tuned. Hey traders, warm welcome to you. Okay, so trading a fast market, what do I mean by this? I mean a market that has suddenly come out with news. Okay, not a volatile market, it's been volatile for a long time. I mean something that's really swinging backwards and forwards, really aggressive moves, and you want to trade it. Now, a word of caution is, hey, this is where you can get absolutely smashed. And I hold my hands up and say, you know what, I've got involved in markets I shouldn't have, and I've paid the price, and I've gone out of the market with my tail between my legs and thought I need to be a little bit more careful, because you've got to be careful with size, you've got to be careful with slippage, you've got to be careful that you're stop, you know, so many things. Example, I'll give a real world example. When was this? Probably, I don't know, 2008, something like that, probably 2008, because that's all kicking off, maybe a little bit earlier actually, maybe 2004. Regardless, a while ago, market's all kicking off. In I go, steaming in, see a lot of opportunity, go long, my normal clip size, and by the time I've gone long, the market has retraced 80 pips on me. Now this thing, you know, normally, well, bearing in mind I'm normally looking for kind of 25 pips profit, so 15 pips stop, around that sort of, you know, level, can't remember the exact numbers, but that kind of thing. Swings right back, and by the time I've even been able to get my stop in, the thing's 80 pips, 90 pips, 100 pips again. You get the idea. And so that's a massive loss to take when you're only expecting to take 15 pips. That's just bad trading. Hold my hands up and say bad trading. So don't make that mistake. Don't pile in doing that with the initial size. One is being mindful of volatility. The other is dial down the size massively. That wouldn't be a big deal if I was 1/10 the size, right? 150 pip loss, 1/10 the size, normally 15 pip loss, you're okay. So be warned of that. But let's talk about setups and strategies. Risk management's always got to be a priority for you. I'm pretty sure you guys get that, especially for subscribers. You know that's what we're all about. Risk management is good, should be the number one thing you focus on. But let's look at this trading strategy that we could do from a fast market. So assume that we have the market sitting there doing not a lot, and all of a sudden we rocket off to the upside. Some news has come out, whatever it may be. Now, the first thing you do is when news comes out, your instinct is to scramble to see what the news is. Now, in some ways that can be good. So for example, I'm going to think of a really bad example here now, but let's say you spike to the downside and the president had been assassinated. That is pretty bad news, and is unlikely to see a rebound. Now, bearing in mind, I would like to add that we did have a rumor come out. Somebody had hacked the AFP, I think it was, news site on Twitter, and said there was a bomb attack on the White House, and it was completely false. Obama was injured. It was complete false news, and we had a shudder like this. So possibly not the greatest example, but the idea is that sometimes you want to see if the news is, if there is news. Okay, that's, you know, when 9/11, but I was trading during 9/11 and the news was coming out slowly. No one was quite sure what's going on. So it's not always that good to see the news, because even if it's something catastrophic that you know is going to impact the markets heavily, initially it's so fragmented, and of course social media distorts it and people are tweeting pictures. It's very difficult. So my recommendation, and what I do now, is I just look at price action. You know, when I'm not in a position, I will just see what the heck is going on. But I want to, if there's an opportunity there to trade it, I'll trade it. And so if I'm trading, you basically got to make two decisions, right? You've got to do this, or you've got to do this, or actually I should add another or here, nothing. Yeah, that's 9 times out of 10, guys, this is what you want to do. You don't want to have the knee-jerk impact of diving in one way or the other. But if you've got a predetermined plan for it, then you can, within the realms of the structure of your plan. So a follow trade will look like this. You know, once we've had an initial spike up, the very first thing I will do is I will put a fib line on, or not a fib line, just a 50% line, as you can use normally with the fib tool, which is why I say that. You can have your 50% line here, and you can say, listen, while it's above that 50% line, longs are okay. Yeah, as soon as we get below that, longs are out. And actual fact, you can very roughly use that as a stop loss. I know it's too wide really, but when things are really kicking off and it's swinging about, it's an easy thing to visually have in. You've got your level there. You can just put your ticket and stop. It doesn't mean you can't come out earlier, but it means you've got some protection. Or even if you have the other fib level here, 61.8, whatever it is, you can put your stop loss there. But the idea is as long as you have some stop loss protection. So if you're trading the follow trade, you want to wait and see how it behaves after the spike, because very often it may well spike and spike back down again. Fortunately, if you do go long there, you've got your stop there. But the idea of this is you want to see, wait until a retracement. This is possibly the best advice that I think there is out there, is that when the markets rip up, do not chase it. This is why having a plan helps you not chase it. So the market goes up, the market pushes back. This is the key point now. Okay, you've waited for the first pullback. You want to see the behavior. Yes, you've got the spike. How deep is the pullback? If it's really, really deep, you probably don't want to follow it. If it's very, very brief and starts to go again, and the size of the candles, let's say the red candles are this compared to the green candles are this, you can have a go at it. You can say, listen, you know what, that looks reasonably good. I'm going to go long here. I've seen a pullback. I know my worst case scenario is that I can probably bring it up under that pullback level, which would be here. Let me see if I can get some real meat out of this. And if you get on the end of an absolute beast of a move like that, that is very, very profitable and lucrative. Position sizing wise, be very cautious, like I say. If you want to add to it, you're more of an advanced level and you think, hey, you know what, I'm on the end or the start of potentially a big, big bullish move, add to the position as it goes in your direction. Never add to the position as it's coming against you. So let's quickly look at the fade trade, guys. The fade trade will be the same kind of thing. We've got a nothing, then bang, straight up. Again, same scenario. We draw a line in the sand where we would want to fade it rather than anywhere else. Now, is this a hard and fast rule? No, but it works because it keeps you out of trouble. The main thing you want to do with this stuff is not get caught and do anything that you shouldn't be doing. So, line in the sand again, 50%. Market moves up, starts to pull back. As always, waiting for that first pullback. That's the key point. Waiting for the first pullback. What's the price response on the first pullback? If this news is just BS, this will start drifting lower. We've got an opportunity. If it's significantly bullish, we have this scenario. So market starts to pull back lower. What happens? It then drifts and drifts and drifts and drifts and eventually starts to go here. Now, under the 50% of this, by the way, 50% is this to here. So if that's 100 pips, that's 50 pips off the high. Hopefully I've explained that. Coming back, now we're potentially in short mode. Right now we're potentially in short mode. We can draw our stop loss just above that. We can use the fib again if we like, or you can use a quarter. What doesn't really matter, you know, we're not going to say it's definitely going to work with just a fib number or whether it's going to be a third of the move or whatever. The point is just at least bracketing the trade. When we're under here, now we're ready to go. Now we're looking for a short opportunity. You can even short it as it comes through the 50 and have your stop up there. If it's a genuine fade trade, this thing will come straight back down and will be exactly where it was before it started to move. Very, very nice trade that, and that happens very, very often. But wait until it comes back down as opposed to trying to be clever here. Too many people trying to nail it here, and it's tricky. Maybe you get the odd one or two, but you know, I think you prefer to wait until you at least see down momentum. When it starts looking bearish, goes to that 50%, there's your opportunity to hit the short. As long as you have your stop loss in, then obviously your primary target is going to be a breakthrough back of where we were. But don't underestimate the power of this thing just falling through the floor. Yes, it will likely overshoot. So maybe second scales for you is going to be scaling into a fresh low from here. But like I say, don't underestimate the fact that if this is news that was initially considered bullish and the price response is bearish, I've seen markets do this 100, 150 points up on the Dow or something, and then crater through the floor, double that move, and then spend the next 3 days getting decimated. So up to you. If you think if you prepare to give a bit back, and why wouldn't you be, then, and you've got a nice short position on here, and this thing then closes at lows in the day, and you're holding it for the next day, all of a sudden, you know, you've got a 20-to-1 risk reward ratio trade, or, you know, a month making play. So that's something to look at, guys. The key points of this while we end this video is that number one is your position size. Be very, very cautious on that. Number two, have some level of stopping. That may not be ideal, but the point of in a fast market is that you can't finesse stuff too much. You can't be fiddling around looking for the perfect stop position. Just get that stop in, get it wide enough so that it's not going to get pinged out straight away on noise, and get that thing in to protect your position, which is why I say 50% is a good place to kind of start the ball. Yes, once you're in, you can maybe adjust it. You see some double tops, some resistance, whatever, you can start to play with it and bring it up or down accordingly. But just getting something in to protect you, so don't do what I did as time ago and just get absolutely battered because you're buying at highs, the whole thing falls through the floor by the time you're in. You know the score. So anyway, guys, trading a fast market, follow or fade. Some ideas there, thoughts in the comment section below. If you like this kind of stuff, thumbs up, much appreciated. Take care, guys. Bye bye.